Welcome to today's analysis, where I'll be discussing two high dividend yield companies that I believe are worth considering for your portfolio in October 2024. Dividend-paying stocks can be an effective strategy to produce steady income while reducing portfolio volatility, and I've personally selected these companies based on their ability to combine dividend income with long-term growth potential. Hey everyone, welcome to Market Visionary. I'm just starting out, and I need your support. If you're enjoying this content, please hit thumbs up, and subscribe. As a thank you, I'm offering gifts to my early supporters. Just comment, subscribe, take a screenshot, and email it to the address in the description. You might get a special reward. Thanks for being here. Let's grow Market Visionary together. In this video, I'll break down why I think these two companies stand out, the allocation strategy you might consider, and the growth potential I see for the years to come. Let's dive into my picks. Investment thesis. In today's market, volatility is still a concern for many investors. Dividend-paying companies can play a key role in providing not only income, but also reducing overall portfolio risk. They act as a buffer, offering regular income during uncertain times and the opportunity for long-term capital appreciation. For this month, I've selected two high dividend yield companies that combine the benefits of dividend income and dividend growth. Ares Capital, ARCC, and Sixt SE, OTCPK, SIXGF. These companies offer attractive valuations and dividend yields that make them worthy of consideration. I suggest limiting exposure to these companies to maintain a diversified portfolio with an allocation limit of 4% for one and 2% for the other. My first pick, Ares Capital, ARCC. Let's start with Ares Capital, which is a business development company. At its current price of around $20.88, Ares Capital offers a dividend yield of 9.12%, making it a strong pick for those focused on income generation. The company's 5-year dividend growth rate stands at 3.84%, showing consistent growth in its payouts. What I find particularly appealing about Ares Capital is that it's traded at a slight premium to its net asset value, NAV, which currently sits at $19.63, reflecting a premium of just 6.37%. This suggests the company is fairly valued, considering its strong long-term performance. Over the past 10 years, Ares Capital has delivered a total return of over 256%, outperforming major indexes such as the S&P 500. This makes it an attractive investment for those looking for a mix of income and growth. Plus, its dividend yield is aligned with its 5-year average, further supporting its appeal at current price levels. I see Ares Capital as a stable income generator that has the potential for dividend growth. And in today's market, with interest rates remaining high, the company's solid fundamentals make it a standout pick for income-focused investors. Its 24-month beta factor of 0.55 also highlights its ability to reduce overall portfolio volatility. The long-term dividend growth projection. If you invest in Ares Capital at its current price and assume a dividend growth rate of around 3.5% annually over the next 30 years, this could lead to a yield on cost of nearly 13% by 2034, rising to 18% by 2044 and over 25% by 2054. This projection makes Ares Capital a compelling long-term investment, particularly for those interested in dividend reinvestment and compounding over time. My second pick, Sixt SE, SIXGF. Now let's move on to Sixt, a German-based car rental company with a current price of around $70.19. It offers a dividend yield of 5.95%, which is coupled with a strong 5-year dividend growth rate of 11.54%. This impressive growth potential makes it particularly appealing for those looking to balance income with capital appreciation. What really draws me to Sixt is its valuation. The company's price-to-earnings ratio, PE, is currently 45% below the sector median, signaling that the stock is undervalued. At the same time, its price-to-sales ratio is below both the sector median and its 5-year average, reinforcing my belief that this stock is a value opportunity right now. In terms of growth, Sixt has seen 12% year-over-year revenue growth and 10.6% EBIT growth. These figures demonstrate strong performance and a robust business model that stands out against many competitors in the automobile and mobility sectors. Why Sixt over auto manufacturers? You may ask why I'm highlighting a car rental company like Sixt instead of car manufacturers like Ford or General Motors. The answer lies in Sixt's business model, which is far less capital intensive and much more flexible. This allows Sixt to maintain higher profit margins, and while companies like Ford and GM struggle with low EBIT margins of 2 to 6%, Sixt enjoys a much higher margin of 12.8%. Sixt's revenue stream is also less cyclical than car manufacturers, making it a lower risk investment over the long term. And compared to other rental companies like Avis or Hertz, Sixt comes out ahead with better profitability and growth metrics, making it the superior choice in this sector. Risk analysis: mitigating portfolio risks. Of course, it's important to consider the risks associated with both companies. Ares Capital faces stiff competition from other investment firms and banks, which could impact its returns. It also invests primarily in privately held companies, which are inherently riskier due to their limited resources. As for Sixt, currency fluctuations, especially with the euro, could affect its earnings. It also faces significant competition in the car rental space, which could pressure its margins over time. To mitigate these risks, I recommend limiting your portfolio's exposure to Ares Capital to 4% and 2% for Sixt. This approach helps reduce company-specific risk and ensures a well-diversified portfolio. A balanced approach for October 2024. In conclusion, both Ares Capital and Sixt offer compelling opportunities for investors looking to balance income with long-term growth. Ares Capital provides a stable, high dividend yield combined with moderate growth potential, while Sixt presents a unique opportunity for growth and income at an attractive valuation. By incorporating these stocks into your portfolio with a cautious allocation strategy, you'll not only secure immediate income, but also position yourself for dividend growth in the future. Remember, it's important to maintain a diversified portfolio to minimize risks and maximize potential rewards. Thanks for watching. I hope this analysis has provided valuable insights. Please share your thoughts in the comments and let me know which high dividend yield companies you're looking at this month. Don't forget to subscribe for more market insights, and see you in the next video.